This is Chris Carlson, and welcome to the Boulder Banking Podcast. My guest is Brad Spears, Senior Vice President and Director, Member Relationships at the Federal Home Loan Bank of Des Moines. Brad leads a team of 10 relationship managers who serve nearly 1,300 members in 13 states. In this episode, we focus on what the Federal Home Loan Bank system does for the banking industry, how it responded to the SVB failure, how banks should be addressing their liquidity, and what banks should be prepared for in their next bank exam. Brad, thanks for joining us today.
Thanks so much for having me, Chris. I appreciate it. Anytime I can talk about the Federal Home Loan Bank system, I'm more than happy to do so. Appreciate you giving me the opportunity.
Well, Brad, let's kick off today by you giving us a kind of a brief background of Brad Spears.
Sure. Born and raised in the great state of Kansas. Grew up in a town called Olathe, which when I moved there in 1972 had only 5,000 people. As we sit today, it has almost 200,000. So tremendous growth. After graduating from high school, went to Kansas State University, got a degree in economics and finance. Went to work actually in the credit union industry for an entity called U.S. Central Credit Union. And then started to work for a broker dealer, CNBS, that was owned by U.S. Central, and did ALM consulting and economic and investment consulting for credit unions all throughout the country, and was fortunate enough to join the Federal Home Loan Bank of Des Moines in 2005, and I have been there ever since. So I have two lovely daughters, both of whom are college graduates. One attended the University of Alabama, one attended the University of Arkansas, and my wife and I will be celebrating our 27th wedding anniversary in November. So that's about me. That's all about myself, and I'm just looking forward to answering your questions, Chris, as we go through the podcast.
That's a great background. Thank you very much, Brad. Well, let's start here, Brad. Give us a high-level overview of the Federal Home Loan Bank system.
You know, it's interesting because I'm asked a lot of times, I tell people I'm in banking. When I explain to them what I do, you know, the Federal Home Loan Bank in the name is a lie. Number one, we're not federal. Number two, we don't do home loans. And number three, we're not a bank. It's really an interesting system. It's a system that no other economic superpower has. It is a system that was developed back in the 1930s. You know, Herbert Hoover was a native Iowan. I now live here in Des Moines. He was not a very popular president and is widely panned as one of the, if not the worst president of all time. But one of the things he did do that was quite positive was he passed the Federal Home Loan Bank Act of 1932. Coming out of the auspice of the Great Depression. And that created a 12 centralized locations across the country. And if you don't think politics were alive in the 1930s, there's a Federal Home Loan Bank in Des Moines because that was Herbert Hoover's hometown. And there's a Federal Home Loan Bank in Topeka because that was his Vice President Charles Curtis's hometown. So the Home Loan Bank is unique. It is a system of cooperatives that was initially built. Our essential mission when we were created was to provide liquidity to all of our members and to help them support their housing finance and community development through all economic cycles. During the late 80s, early 90s, when FIREA passed, we had a secondary mission added, which is support affordable housing, which we do each year by giving 10% of the prior year's income to our members to support affordable housing. So the Federal Home Loan Bank system is unique in that we are all independently owned and operated. We have our own board of directors. We have our own policies. We have our own procedures. However, the one thing we do in consortium is issue debt. We issue debt through the Office of Finance, which is actually headquartered in Virginia, and they have relationships with broker dealers across the country to issue our debt. That debt is in turn used to fund our activity with our members. So it was a system that is relatively simple in the way that it's composed, but has really done a nice job of contemplating even the most difficult economic circumstances in our 90 plus years of existence. So that's kind of a high level overview. It is unique. The Federal Home Loan Bank system is unique. I mentioned that I have a difficult time explaining to people what I do because it really is something that you don't see in any other economy across the country. And I think it's really done a nice job of making sure that we have the flow of credit and capital from Milan, Missouri to Reston, Virginia, to Guam, to Hawaii. It allows community financial institutions to make sure they have access to credit, no matter what the population is that they serve.
Well, you mentioned tough economic times. How well do you think the FHL bank system responded to the Silicon Valley Bank failure?
I'm probably not the most unbiased source, but I will tell you that the day after Silicon Valley, the system had their largest issuance of debt in one day. It was $90 billion. We filled every single member request. When I say we, I mean collectively as a system, filled $90 billion worth of requests for funding on that day. It was really, the system functioned the way it was designed to be functioned. We have seen the Great Recession back in 2006, 2008. We saw the thrift crisis. The Federal Home Loan Bank has been able to weather all kinds of economic storms. And really, it's the way the system was built. Our balance sheets ebb and flow based upon member activity. We shrink when times are a little bit slower, and we grow when times are relatively fast, and we're seeing rapid growth. That's the way our structure was created, is allow us to be able to, with the ebbs and flows of the tide, be able to either shrink or grow dependent upon our members' needs. So, during the last recession, the Federal Reserve Bank of New York wrote a really positive op-ed dubbing the Federal Home Loan Bank system the system of next to last resort. I would say that in subsequent years, we'll see a similar type of study. I don't know who will do it, depicting how much the Federal Home Loan Bank and access to the Federal Home solidified a shaky banking situation where, in essence, as we look back on today and we see how everything's connected via social media, one tweet resulted in $42 billion of deposits being withdrawn from SVB. So I really think that's when the Federal Home Loan Bank stepped in. We were able to stabilize the banking industry. Now, I would also be remiss if I didn't mention that the Federal their Bank Term Funding Program also had a hand in stabilizing the banking situation. But it could have been it was a very significant event, but it could have created catastrophic consequences. I think having the Federal Home Loan Bank system in place really helped to stabilize the banking industry and allowed them to continue to serve their customers despite the fact that they were under an avalanche of scrutiny and bad press.
Well, what factors contributed to these liquidity events, in your opinion?
There's a multitude of factors. Number one, the most important is the fact that we saw 11 rate increases from basically March of 2022 to the present, 525 basis points. We came out of what we call the ZIRP, the zero interest rate policy by the Fed. Essentially from December of 2008 to December of 2015, we saw rates go up a little bit. And then, of course, in March of 2020, COVID hits. And from March of 2020 to March of 2022, the Fed basically lowered the funds rate to zero. And what we saw was several factors: changes in the composition of most institutions' balance sheets, in particular on the liability side. We saw a movement away from CDs into money markets. In 2005, certificates of deposit represented about, on average, 40% of a bank's liability side of the balance sheet. By 2013 and 2014, that was down below 20%. Now, what that does is it eliminates a contractual part of your liability base, a permanence. A CD has a start date and an end date. A non-maturity deposit doesn't. Theoretically, I could put my money in an institution and they could send me an email that I don't like or whatever, and I could go and withdraw that money the very next day. So we saw a significant shift in the liability side of the balance sheet. It shortened up. It moved from something with a contract and permanence into a product that was cheaper, but really didn't have that permanent aspect. And on the asset side, we started, since loan demand was slowing down, we started to buy longer term investments. So we went longer on the asset side. And from an asset liability mix, when we fund long assets with short liabilities, that's fine if rates stay relatively flat or rates even decline. But the one thing that creates significant difficulties with that type of interest rate risk profile is a dramatic increase in interest rates, which is what we saw. So it was a multitude of factors. It was inflation, which caused the Fed to increase rates 525 basis points in an 18-month time period. It was just an evolution over time where the liability side of the balance sheet, the way we fund ourselves, lacked permanence, lost contractuality, moved from CDs into non-maturity accounts, and it was the lengthening of duration on the asset side. So we basically bought longer-term investments because you were looking at 2-year investments at 40 or 50 basis points. So if you go out 4 or 5 years or 10 years, you may actually get 2% or 1%. And as we all know, banking is a spread and margin game. So as we can maximize margin, theoretically, that builds a safeguard for capital and for earnings, except for when rates rise. And we saw a dramatic increase in rates over a short period of time.
What should banks be doing today to shore up liquidity?
So in essence, we've seen a liquidity run on a bank. Liquidity can be created in one of two ways. It can be created on the asset side. That's why we buy securities. So one of the things I failed to mention before, that the factors that contributed to the liquidity events, was the fact that all of these investments that we purchased are fixed rate. So when rates go up, they are now underwater. I'm actually earning a below market rate. So instead of, if I bought a 2-year investment and rates go up 525 basis points, I could buy that same investment at an appreciably higher rate. So that adversely impacts the value, which adversely impacts my ability to liquidate that investment at a gain. I'm most likely going to cause it to lose. It's important on the asset side that if you create a loan or you create a security, that loan is pledgeable, or that security is pledgeable to at least more than one entity. So my advice would be, create a contingent liquidity plan, identify sources of liquidity, pledge every single asset you possibly can. If it's not pledgeable to the Federal Home Loan Bank, pledge it to the Fed, pledge it to a correspondent, pledge it to someone else. The Federal Home Loan Banks can accept consumer loans as collateral. Those consumer loans can be pledged to the Federal Reserve Bank. They should be. Every single asset you have can potentially be turned into a source of collateral. Make sure that you're pledging that and gaining some liquidity off of that, because you can never have enough liquidity. When that cycle turns, it's really, really difficult to gain access to funding in a relatively short period of time. One of the things you should also do from the Federal Home Loan Bank perspective is make sure that when your lenders are making loans, they're making loans that adhere to the eligibility guidelines of the Federal Home Loan Bank, that they're eligible to be pledged. So what I do with a lot of my customers is, once a year, I go in and we talk to their loan ops people, their loan administration people, about how a certain commercial real estate loan or residential real estate loan or agricultural loan can be pledged to the Federal Home Loan Bank. What are our eligibility requirements? So the key when you're accessing your Federal Home Loan Bank and making loans is to pledge eligible collateral. So having the Federal Home Loan Bank or your rep come in and talk to your loan ops people about how to make eligible loans is important. Because as you grow the loan portfolio, theoretically, if those loans are eligible to be pledged, you can grow your ability to borrow from the Federal Home Loan Bank. So I would do the same thing with the Federal Reserve Bank. Have them come in once a year, make sure you're making loans that meet their eligibility guidelines. So I think the key things they should be doing now from a liquidity standpoint is, number one, creating a liquidity funding plan, contingency liquidity funding plan. Number two, if there are lines of credit identified in that plan, make sure they're prepared administratively. They should be testing those lines once every quarter. And I'm not just talking about testing it and putting it into your account. Wire the money out and then pay it off the next day, so that you have everything in place from an operational standpoint, so that I tell my members all the time that when you call us on the phone, we literally have the money in your account within 2 minutes. That's if you have all of the operational logistics ironed out. It doesn't take a lot longer to do that. However, if you've tested that and you've got that already in place and you're in a real crunch for funding, that could be a true benefit as you look to get that money in an expeditious fashion. So make sure you are testing your lines. If you have them listed in your liquidity contingency plan, make sure you're testing them and make sure you're operationally prepared. Make sure you're maximizing your collateral pledge, be it at the Federal Home Loan Bank or the Federal Reserve Bank. Every asset you could possibly pledge should be pledged, and making sure you're buying securities that can be pledged and that, dependent upon rate environment, maintain their liquidity structure perhaps better than some others.
Well, Brad, what do you think regulators will be focusing on their next exams of a bank?
Barclays put out a really, really interesting graph based upon the fourth quarter data. They took the 25 largest banks in the country and they looked at, on one axis, the percentage of uninsured deposits and the percentage of their net long-term assets. And there were two institutions that stuck out as outliers that were high in both: Silicon Valley Bank and First Republic. So if you look at that graph and you think about, okay, if I have a high number of uninsured deposits, which means theoretically, what we really saw during the crisis was institutions, in particular corporations, move money out of the banking system and put it into money market funds or bought treasuries. They learned that I could buy a 3-month treasury at 5.25%, and my bank's only paying me 3%. I could take that money out and put it somewhere else. Obviously, they're going to be looking at that. The regulators are going to be looking at, do you have plans from a liquidity perspective that if you have this large number of uninsured deposits, what happens if a large customer goes away? What plans do you have to augment that loss of your deposit base? Because a lot of institutions saw money roll out simply because of the instability and the fact that there were better alternatives, higher yielding alternatives. We saw a little bit of disintermediation. So they're going to be focusing on liquidity first and foremost. What is your liquidity contingency funding plan? Have you accessed your lines of credit? Have you tested your lines of credit? Are you operationally ready at all of those sources of liquidity you have identified? Could you pick up the phone today while I'm actually examining you and have money in your account? They're also going to be looking at interest rate risk. I mentioned before, the complexion, balance sheet shifts actually matter every bit as much as interest rate shifts. And I talked earlier in the podcast about how the composition of the liability side had shortened and the composition of the asset base had lengthened. That creates the interest rate risk conundrum that if rates go up, I've got my assets not able to reprice. My liabilities are repricing faster than my assets, which starts to impair my margin. And that's really what we've seen. So I really think they're going to look at liquidity first. They're going to identify, do you have a plan in place? If deposits continue to roll off or you lose one of your largest depositors or your name gets in the press, do you have access to fungible liquidity? They're also going to look at interest rate risk. How are you structured? If we saw rates run up 525 basis points, what if rates run back down to zero again? How does your balance sheet look? Are you measuring that? Are you modeling that? And I think secondarily, they'll probably look a little bit at credit risk. Obviously, asset quality is important. Thus far, we have not seen a lot of increase in asset quality issues with institutions. But as we all know, commercial real estate, because of the pandemic and the number of institutions that are actually allowing their employees to work in a hybrid model, we're seeing a lot of commercial real estate space that is not being released. They're letting their leases expire and they're allowing most of their employees to work from home. So primarily liquidity risk is paramount, interest rate risk, and then they're probably going to look at asset quality and capital as well.
Well, given that input, what are the plans of actions banks should be doing as next steps?
I mentioned before, you should make sure that every single asset that could potentially be pledged can be pledged. You should also be looking at all of your secured lines of credit and all of your unsecured lines of credit. Do you have everything in place to be able to access those at a moment's notice? Have you been testing? Have you been documenting those tests? When you're talking to your ALCO committee, are you running them through scenarios from a liquidity standpoint and from an interest rate risk standpoint? Are you keeping your board and your ALCO informed? Number one, what are your policy limits in regard to income at risk and economic value at risk? Is that clearly delineated in the reports? Is it being communicated to your ALCO? They're going to look a lot at your ALCO package. How are you pricing your loans? How are you pricing your deposits? How are you planning for contingent liquidity? And how are you measuring interest rate risk? So the ALCO committee should be the center of the institution right now. Everything that we just talked about should be front and center and paramount. What are we going to do with our investment portfolio? Are we going to take some losses? How are we going to restructure that going forward? I mean, I want someone at an institution to not look at what we just came out of, but identifying what's the next potential stone to drop, and how can we react to that? So I think that shoring up liquidity, clearly communicating to your board and your ALCO what your interest rate risk position is and what your liquidity position is, and your plans to address any deficiencies is what they should be doing, in addition to making sure that every single asset that you have able to be pledged is pledged somewhere.
Well, let me ask you this. What concerns you most about the banking industry in the near term?
We're in a declining margin business. That's just the facts. And we're in a declining number of institution business. We're at 6,500 institutions. We have an administration in place that would like to see that number get down to probably 200 to 300. There's a lot of pressures towards consolidation. You know, as we come out of a crisis, we see the regulatory pendulum swing either way. We get too onerous on one side and then perhaps not as onerous on another side. We're moving into an arena where we're going to see a lot of regulation because we have seen some cracks in the banking industry. We've overcome those cracks, but as we all know, the regulator's job is to basically protect the industry and protect the fund. So if they see areas where perhaps more regulation needs to be installed, they're going to do that. So it's going to be difficult in the near term for institutions. They just have to weather this storm. It's going to be difficult to grow, and it's going to be difficult to grow earnings and capital because what they're paying for deposits is going up actually faster than what they're getting on the asset side. So in the near term, what concerns me is overreaction from the regulatory side, which would impugn or damage an industry that is just now starting to recover. So any type of regulation that's put in place could potentially stop that recovery. Not necessarily cause it to completely stop, but slow it down, impede the recovery. So that's my main concern. And I think it's natural when you come out of a crisis, you're going to have more regulation. That's to be expected. Banking is a regulated industry, and for good reason. So my near-term worry in the banking industry is that we will see more regulation, and that regulation probably will not be accretive to overall earnings and capital. My long-term fear is that it's an industry that is really having a difficult time interesting younger people in becoming bankers. You know, when I was a kid, we used to go to the bank every Saturday, and we would sit there, and it was always fun to go to the bank because, you know, my parents were very loyal to our community bank. And we just don't see that anymore. So from a long-term perspective, we as bankers and as the banking industry have to do a better job of attracting younger talent and getting this younger generation energized to the good things that banking can do. You don't know how many times I've been with my members and we drive around town and they'll point to, you know, that auto body shop. We gave a loan to the individual that started it. They had a small business loan. We had a member of ours that took out an advance from the Federal Home Loan Bank, and it actually funded a jail in their county that added 83 permanent jobs. If you look at every single economic superpower, the one thing that differentiates the United States from others, and it's the reason why the Japanese have studied this, is our community banking model, which allows credit to flow from one end of the country to the other instantaneously. It makes sure that rural areas are covered from a banking perspective in a similar way to urban areas or larger areas. But I think in the long term, we have to find a way to energize younger people and make banking sexy again, for lack of a better term. We have to attract that younger generation and make them understand the importance of a community banking model to the overall foundational and fundamental runnings of our economy.
Well, Brad, it's interesting. You're the second person that I have heard mention that 200 or a little over 200 banks left. And it just, to me, it's so hard for me to get my arms around going from 4,000 plus to 200. And then does it take away from everything you just talked about the importance of a community bank to a community?
Absolutely. It's, we've seen the Canadian bank model. There's 6. It doesn't work. And as I mentioned before, it's proven time and time again. Let's just take, for example, PPP. So we've seen the Small Business Administration be contracted quite a bit. So Congress and the administration had the problem of how do we get this money out quickly? What they did in their infinite wisdom is they figured out, hey, we have 6,500 community banks that know their customers and already have relationships with these customers. They can get money out faster than anyone else. So I'm a big believer in community banking. There is no doubt in my mind that there are pressures in Washington to consolidate. Now, the 200 number we may never get down to that number, but there is a push, and make no bones about it, for consolidation in the banking arena. I mean, it's started over the years, and I think now it's been trumpeted even louder that they would like to see further consolidation and to see the number of banks reduced. There's no question about that. Now, this is me talking. I'm not talking on behalf of the Federal Home Loan Bank System. That's Brad Spears talking. That's my personal opinion. But I think if we do that, we make a tremendous mistake. The community banking model that we have in this country is legendary. It's like the Federal Home Loan Bank System. Time and time again, it delivers. It delivers us out of crisis. It allows us to solve a lot of economic issues relatively quickly. It would be tragic to me if we somehow lost that system.
Well, Brad, I think a lot of politicians ought to listen to you because you definitely hit the nail on the head. And some of those politicians obviously have that stinking thinking, and we can't afford to have that happen to our community bank system.
Well, and I think too, Chris, one of the things we have to do is from the trade association side, we have to continue to tell our story. Bankers a lot of times are a little bit shy to do that. We can't be shy. We have to be able to tell all of the good things we are doing. There are so many wonderful things that bankers do each and every day in their communities that really go unseen other than to the people that are involved in that transaction. So, your support of your trade associations, your ability to visit your congressmen and women is extremely important because we're under attack, whether we realize it or not. There are forces that would like to see consolidation in the community banking world, and I think we have a great story to tell, and I with the Federal Home Loan Bank being a large part of that. So I would encourage you all to go out and scream from the mountaintops the good you do in your community.
Well, Brad, you've dropped some awesome nuggets in this podcast. I'm sure some people are going to maybe have some further questions or want to go deeper with you on some of the things that you said. What's the best way for our listeners to get in touch with you?
Obviously, email. My email is bspears, B as in boy, SPEARS, at FHLBDM.com. So bspears at FHLBDM.com. I'd love to hear from you. And I do want to point out that Obviously, I am one person within the Federal Home Loan Bank system. I'm not speaking on behalf of the whole system. I'm speaking on behalf of myself. But I am a big believer in the Federal Home Loan Bank system. I'm also a tremendous believer in the community banking system in our country. And I'm proud to play a role through my affiliation with the Federal Home Loan Bank and seeing that system flourish through every single economic crisis that could be thrown at us. So I certainly appreciate the opportunity to visit with you today, Chris. And I appreciate it and love to hear from all of you.
So, Brad, I know you've been on the road. You're very, very busy. We really appreciate you taking time out of your busy schedule to visit with us today.
Thank you very much. I appreciate it.